Welcome to the Deep Dive. I'm your host, and today we're embarking on a truly captivating exploration. We're taking a deep dive into Schneider Electric SE, an absolute titan in energy management and industrial automation. You know, a company that quietly underpins so much of our modern world.
It's a genuine pleasure to be here to unravel this story. What we have before us is, well, it's a rich stack of comprehensive analyses, cutting-edge research, and their own detailed company reports. Our mission today is to meticulously sift through all this material, pull out not just the facts, but the most important nuggets of insight, those aha moments, if you will, and really understand how this nearly 190-year-old company is not just surviving, but actively shaping our increasingly digital, electrified, and sustainable future.
Exactly. Think of this as your shortcut, your way to becoming incredibly well-informed on a company that is just foundational to so much. We're going to connect some really big dots, uncover some surprising transformations, and yeah, aim for those genuine moments of insight. You'll walk away with a crystal clear picture of what makes Schneider Electric tick, why its business model is so compelling, and what makes it such a pivotal player in the global megatrends that affect all of us every single day.
We're not just looking at a company here, we're really dissecting a case study in strategic evolution. We'll delve into their business model, dissect their financial performance, pinpoint their strategic positioning, and even touch on their valuation. But this isn't merely about the numbers, it's about understanding the why behind their profound impact and how their journey reflects much broader global shifts in technology, energy, and industry.
Okay, with that big picture vision in mind, let's zoom in. Let's get to the core of what they actually do and how they've evolved to meet these new challenges. So, Schneider Electric, right? When you first hear the name, you might instinctively think of something fairly traditional, perhaps circuit breakers, or maybe industrial machinery.
Yeah, exactly. Heavy industry, maybe.
But as our sources strongly emphasize, this company, which began its journey all the way back in 1836,
Yeah, quite a history there.
right, it has undergone a truly remarkable metamorphosis. It's quite a journey from heavy machinery and steel manufacturing to what they are now, isn't it? What's their core purpose, their North Star today?
What's truly fascinating here is how their nearly two-century history isn't just, backstory. It's the very foundation that underpins their current incredibly ambitious mission. They haven't just adapted to change. They've systematically and strategically pivoted to place themselves squarely at the epicenter of three of the most powerful global trends of our time: widespread electrification, pervasive digitalization, and the urgent imperative of decarbonization.
Okay.
Their core purpose, which they brand powerfully as Life is On, is to empower all to make the most of our energy and resources, bridging progress and sustainability for all.
Yeah.
Now, this isn't just high-minded corporate jargon. It's a foundational strategic alignment. It dictates their entire product portfolio, their R&D investments, their future direction. It fundamentally shows a company deeply entwined with the essential evolving needs of modern society.
That mission statement, Life is On, it sounds aspirational, but for us, the listener, what does it truly signify? Why should we care about this particular framing of their purpose?
Well, it's more than just a catchy slogan, I think. This mission statement is critical because it immediately signals that their commitment extends far beyond merely selling individual products. It positions Schneider Electric as a solutions provider addressing essential societal needs, ensuring we have reliable, efficient, and increasingly sustainable access to energy and resources. Understanding this context helps us interpret their diverse business segments and strategic moves. It indicates they're not merely reacting to market demands. They are actively trying to shape a more sustainable and electrified world. And crucially, by doing so, they are creating immense, durable commercial opportunities for themselves, often by helping other companies achieve their sustainability goals.
That contextualizes their ambition beautifully. Now, turning to their operations, our sources break down their business into two distinct yet clearly complementary segments. Can you walk us through those? What are they, and how do they interact to form this complex enterprise?
Absolutely. Schneider Electric operates with what's often referred to as a two-speed enterprise model. It comprises two highly synergistic business segments: energy management and industrial automation.
Okay.
Energy management is by far the larger and currently faster-growing segment. It accounted for approximately 79% of their group revenue in fiscal year 2023.
79%, wow.
Yeah, it's the big one. And this segment encompasses everything related to electrical power distribution and management. This ranges from the low-voltage circuit breakers and switches that are, ubiquitous in every
No, that's
building.
stuff you see everywhere.
Exactly. To sophisticated medium-voltage distribution equipment used in vast electrical grids and commercial complexes, critical secure power solutions like uninterruptible power supplies UPS systems.
Keeps the lights on, basically.
Keeps things running during outages, yeah. And advanced building automation systems. What's truly pivotal here is that energy management is a primary beneficiary of massive, non-discretionary secular trends. Think about the absolutely insatiable demand for data center construction, booming globally, the urgent need for grid modernization efforts everywhere to handle renewables, and the widespread electrification of buildings and transport.
Huge drivers.
Huge! This segment saw incredibly robust organic growth of 14.4% in FY23. Underscoring its pivotal role as a high-growth engine.
So if energy management is the sprinter riding these powerful, almost unstoppable waves of demand, industrial automation sounds more like a marathon runner, right? What's its distinct role and how does it balance the portfolio?
Precisely. You've got the analogy perfectly. Industrial automation represents the remaining 21% of their FY23 revenue. This segment focuses on providing technologies that automate industrial processes and machinery across various sectors. This includes programmable logic controllers, or PLCs, essentially the specialized, rugged computers that run automated factory lines.
Got it.
Along with industrial control products, drives, and a comprehensive suite of industrial software, which has been significantly enhanced by their full acquisition of AVEVA Group, a major industrial software provider.
AVEVA. We'll come back to them, I'm sure.
We will. It serves diverse markets, from discrete manufacturing, like machine builders and automotive lines, to process industries such as chemicals, oil and gas, water treatment, and also supports hybrid automation needs. Now, while this segment certainly benefits from the powerful long-term drivers of Industry 4.0, the digital transformation of manufacturing, it's inherently more exposed to traditional industrial capital expenditure cycles.
Okay, so more up and down with the economy.
Exactly. Its growth can be more cyclical, tied to broader economic conditions. In FY23, this segment posted a more modest organic growth of 6.7%. So you have energy management riding these powerful, non-discretionary investment waves, acting as the high-growth engine.
The sprinter.
While industrial automation provides a strong long-term foundation that offers resilience and exposure to different market dynamics, the marathon runner. This two-speed enterprise model provides critical internal diversification and resilience for the company overall, allowing it to navigate varied market conditions.
That makes perfect sense. Now, how do they actually translate these activities into revenue? Is it just selling physical hardware, or is there a fundamental shift happening in their revenue streams, one that aligns with this digital transformation you mentioned?
This is a critical point, and it truly illustrates their evolution from a traditional hardware vendor to an integrated solutions provider. Schneider Electric has three primary revenue streams, and their shifting proportions are really telling. First, products, which still represents the largest share at 53% of their FY23 revenue.
Okay, more than half.
Right. This is the transactional sale of individual components like circuit breakers, sensors, or variable speed drives, typically distributed through their vast global network of partners. Second, systems, accounting for 28% of FY23 revenue. This is where it gets more complex, involving integrated equipment and project-based solutions.
Like a whole setup for a building or a factory.
Exactly. Think a complete, customized electrical distribution system for a new hyperscale data center, or an entire smart factory automation setup, much bigger ticket items, more complex projects. And finally, software and services, which is strategically the most important, made up 19% of FY23 revenue. This includes high-value software licenses and subscriptions from acquisitions like AVEVA, ECAP, and RIBE, along with crucial field services for their massive installed base and increasingly specialized sustainability consulting.
That breakdown shows a lot of moving parts, and it's clear they're diversifying. But the growth dynamics seem particularly telling. I noticed systems revenue grew much faster than products in Q4 2023, for instance. What does that tell us about the market and Schneider's strategic direction?
That observation is a crucial insight. You're right. The robust 17% organic growth in systems revenue in Q4 2023 compared to just 2% for products.
Big difference.
Huge. It underscores a profound market shift. Customers aren't just buying discrete components anymore. They are increasingly demanding comprehensive, integrated solutions, especially for complex, mission-critical projects like data centers or smart buildings. This indicates a higher value proposition for Schneider, deeper customer engagement, and a more entrenched role in their clients' operations. It's a move away from being just a supplier to being a true strategic partner, delivering complete optimized ecosystems.
And that software and services part, even at 19%, truly sounds like where it gets really interesting for the future. I imagine that's where the higher margins and the stickiness for customers really come into play.
Absolutely. You've hit on a core strategic imperative. This segment is indeed their highest margin and most predictable revenue stream. It's where the company is actively embedding itself deeper into customers' operations, moving beyond hardware sales to providing ongoing recurring value through software subscriptions and expert services.
Right, less transactional.
Much less. This shift is fundamental to their long-term growth and profitability, creating powerful customer loyalty through integrated digital offerings. It represents a significant evolution in their business model, making their customer relationships much more durable.
You've consistently mentioned this idea of a strategic pivot and digital transformation. Our sources call this their digital flywheel. What exactly is that all about, and how does it help us understand Schneider's progress?
The digital flywheel isn't just a catchy term. It's the very heartbeat of their long-term strategy and a powerful metric to track their transformation. It specifically measures revenue generated from connectable products, that is, hardware with embedded intelligence, alongside edge control software and digital services.
Okay, so the smart stuff, basically.
Exactly. The smart, connected part of the business. In 2023, this flywheel accounted for 56% of their total group revenue.
Over half already.
And they have an aggressive target to push it to 60–65% by 2027. This signifies their deliberate two-decade-long evolution from what was once a traditional electrical equipment manufacturer into a bona fide digital technology leader. This transformation has been fueled both by relentless internal innovation and a carefully executed series of strategic acquisitions that have systematically built out their digital capabilities.
And those acquisitions really tell the story, don't they? It's like watching a company systematically acquire the pieces to assemble a completely new identity, from old-school electrical gear manufacturers to cutting-edge software companies.
Precisely. If you look at their history, it's a masterclass in strategic M&A. You see foundational purchases like Telemecanique, Square D, and Merlin Geron back in the late 80s and early 90s, which built out their core electrical distribution business.
The bedrock.
The bedrock. Then came the $6.1 billion acquisition of American Power Conversion, or APC, in 2007. That immediately made them a dominant force in critical power and cooling for data centers, a visionary move, frankly, given today's AI boom.
Definitely ahead of the curve there.
Way ahead. And more recently, multi-billion-dollar acquisitions of AVEVA, Real Software, and ETAP have cemented their capabilities in industrial software, IT energy management, and electrical systems design software. This acquisition strategy demonstrates a very consistent, aggressive, and forward-looking approach to building an end-to-end portfolio. It's enabled them to truly become a technology leader rather than simply an industrial manufacturer. They're not just selling components anymore, they're selling the intelligence and control systems that make the physical world smarter.
Schneider Electric, of course, operates on a global scale. How diverse is their geographic footprint, and what are the current regional dynamics we should be aware of, especially given, global economic shifts?
This geographic spread is one of Schneider's most significant strengths. It provides crucial diversification and resilience. As of Q3 2024, their revenue distribution was remarkably well balanced. North America accounted for a robust 38%.
Big chunk.
Yeah, the biggest. Asia-Pacific, 28%, Western Europe, 22%, and the rest of the world made up the remaining 12%. Recent performance strongly highlights North America as a crucial growth engine, delivering an impressive 15.1% organic growth in Q3 2024.
Wow. What's driving that?
Largely driven by the massive ongoing investments in data centers and critical infrastructure within the United States. Big government stimulus helps too. Conversely, they've faced headwinds in other regions, like a slowdown in China's construction sector and more subdued discrete automation demand in Western Europe, reflecting broader macroeconomic challenges there.
Right.
But their multi-hub operating model, where approximately 80% of sales are produced within the same region as the customer, that is absolutely key to this resilience.
Local production for local markets.
Exactly. It enhances their supply chain stability and allows them to be much more responsive and agile in meeting the varied demands of these diverse regional markets. It mitigates geopolitical risks and reduces reliance on lengthy, vulnerable global supply chains.
You've highlighted how their business is evolving, but one thread that seems to weave through all of this, especially with this push for recurring revenue and integrated solutions, is sustainability. How has Schneider managed to turn what many might see as a cost center or a compliance burden into a powerful commercial driver and a critical part of their long-term health?
If we connect this to the bigger picture, this shift is more than just a change in billing. It's a cornerstone strategy that positions them at the forefront of a global imperative. Increasing recurring revenue, primarily through software subscriptions and field service contracts, significantly enhances predictability, deepens customer loyalty, and ultimately boosts profitability.
Makes sense.
Within their agnostic software businesses, about 70% of revenues in 2023 were recurring, with an ambitious target to reach around 80% by 2027.
Aiming high.
Very. And the performance of AV-EVA, for instance, is a key indicator of this success. Despite the complex transition from a perpetual license model to a subscription-based approach, its annualized recurring revenue, or ARR, grew by a very strong 19% in 2023.
19% ARR growth is serious.
It really is. This robust ARR growth is a powerful leading indicator of future, stable, and high-quality revenue streams. It means Schneider's technology and expertise are becoming deeply embedded within customers' core operations, which significantly increases customer switching costs and solidifies their long-term competitive position. This is the definition of a truly sticky business model, translating to durable value and a resilient revenue base.
That overview gives us a fantastic foundation for understanding Schneider's internal dynamics. Now let's lift our gaze and see how they're leveraging and even driving the titanic shifts happening across the global economy. Our sources clearly state that Schneider Electric operates at the confluence of huge global megatrends. What are these, and why are they so profoundly important for the company's future?
These aren't just passing fads. These are multi-decade transformative forces reshaping the global economy. And Schneider's entire portfolio is, well, it's purpose-built to address them. First, electrification. The world is undergoing a fundamental energy system transition towards electricity as the primary energy vector, driven by everything from EVs and heat pumps to electrifying massive industrial processes.
Right, everything's going electric.
Pretty much, this dramatically increases demand for electricity, which in turn requires colossal investments in electrical distribution infrastructure, an area where Schneider is a clear market leader globally. Second, digitalization. This is the pervasive proliferation of IoT, the Internet of Things, artificial intelligence, cloud computing, transforming virtually every industry and building. It necessitates smart connected devices for real-time data collection and optimization, which is precisely what Schneider's EcoStruxure platform is designed to do. It effectively bridges that critical gap between operational technology, OT, and information technology, IT.
Okay, OT and IT. Can you briefly explain the difference?
Sure. Think of OT as the systems that control the physical world. The pumps, motors, valves, in a factory or a building. IT is your traditional computing, data storage networks. EcoStruxure connects these two worlds, bringing data from the physical operations into the digital realm for analysis and control.
Got it. Makes sense. And the third?
And third, sustainability and decarbonization. There's a global imperative driven by regulations, investors, consumers, everyone really, to drastically reduce energy consumption and carbon emissions, especially considering buildings and industry account for a huge portion of global greenhouse gas emissions. This creates a massive, urgent market for solutions that monitor, manage, and minimize environmental footprints. It's a core value proposition and a huge commercial opportunity for Schneider.
So for you, the listener, if you're thinking about where the world is headed, what you're saying is that Schneider isn't just adapting to these trends, they're actually laying the foundational infrastructure that enables them, quite literally building the infrastructure for that future.
Exactly. They're not merely beneficiaries, they're crucial enablers. And digitalization, through IoT and AI, isn't just about making things incrementally smarter. It's about making them profoundly more efficient, resilient, and responsive. Their EcoStruxure platform exemplifies this, creating that critical bridge between physical operations and digital intelligence, which is absolutely essential for industries moving into, the fourth industrial revolution. Without companies like Schneider, these megatrends simply couldn't scale to the level required to meet global demand and environmental goals.
These markets sound not just massive, but essential. Do we have any sense of their projected size and growth that would really underscore the long-term opportunity for Schneider?
We do. And these market forecasts provide powerful validation for Schneider's strategic concentration and future growth potential. For the energy management systems, EMS market, multiple independent research reports project robust double-digit growth. We're talking a compound annual growth rate, CAGR, ranging from 13% to 15.6% through the early 2030s.
13 to 15% CAGR. That's huge
Yeah,
for such a big market.
it is. This trajectory could see the market size reaching well over $100 billion. The industrial sector is expected to be the largest end user, and cloud-based solutions are consistently identified as the fastest-growing deployment model within this space. This high growth rate directly supports the strategic focus on their energy management segment. Similarly, the industrial automation market is poised for strong expansion, projected at an 8.2% to 10.8% CAGR, reaching approximately $400 billion by 2030.
400 billion, wow.
Yeah, a massive market. This growth is driven by the ongoing adoption of Industry 4.0, the increasing deployment of robotics, and the deeper integration of AI and IoT into manufacturing processes. Now, while the industrial automation market is more susceptible to economic cycles, as we discussed, it still provides a substantial long-term runway and strong underlying structural drivers.
With markets this big and critical, Schneider Electric is certainly not playing alone, are they? Who are the other heavyweights in this arena? It sounds like an arena for titans.
It is indeed a market dominated by a handful of global titans, often referred to as a quadropoly. Schneider Electric's primary competitors are formidable industrial giants. Siemens AG, the German conglomerate, ABB Ltd, the Swiss-Swedish multinational, Eaton Corporation Plc, headquartered in Ireland but with strong American roots, and Emerson Electric Count from the U.S.
Okay, the big names.
The really big names. Other significant players in specific niches include Honeywell, General Electric, and Rockwell Automation, and each brings formidable strengths. Siemens is incredibly strong in digitalization, automation, electrification, with a particularly powerful offering in industrial software and factory automation. ABB is a leader in electrification, robotics, motion control, strong in industrial robots. Eaton has a deep focus on electrical products, systems, services, a key competitor in energy management, especially in North America. And Emerson Electric is a leader in automation solutions, with historical strengths in process automation.
That's a powerful lineup of rivals. So what's the nature of this competition now? Is it still just about who makes the best physical component, or has the game changed significantly?
That brings to mind another crucial aspect. The nature of this competition has fundamentally shifted. It's less about individual product specifications now, and much more about who can offer the most complete end-to-end integrated platform. Essentially, who can provide the most comprehensive ecosystem encompassing hardware, software, and services.
So it's a platform war almost.
It really is.
Mm-hmm.
The competitive dynamic is moving towards offering holistic solutions that address complex customer problems rather than just selling discrete parts. This shift inherently favors large-scale players like Schneider and its peers, who have the vast resources, established brand recognition, and extensive portfolios to deliver truly integrated, full-stack solutions. It's a battle for platform dominance, not just product superiority.
So, given this intense rivalry among industrial giants, how does Schneider Electric truly stack up in terms of market share within this competitive landscape? Are they truly a leader across the board, or is it more nuanced?
Well, precise consolidated market share figures are notoriously difficult to pin down in such a fragmented and diverse industry. But analysis of various subsegments provides a clear picture of Schneider's strong market position. Schneider Electric is consistently ranked as a market leader in energy management systems, often alongside Siemens and Honeywell. In core product categories like circuit breakers, they are a dominant force globally, sharing the top tier with Siemens and ABB.
Okay.
In fact, the company itself self-reports holding a #1 or #2 market position in most of its key electrical distribution markets.
Right.
That's a powerful indicator of their strength. However, the market is highly competitive, and leadership can indeed vary by specific segment and geography. It's nuanced.
Right, like building automation you mentioned.
Exactly. For instance, in building automation systems, one report suggests Schneider's share of around 0.86% trails that of specialists like Johnson Controls, who have nearly 7%, and broader rivals like Siemens and Honeywell, each around 2.7%.
Interesting difference there.
It is. The key takeaway here is that while Schneider is dominant in core electrical distribution and a leader in EMS, they face intense specialized competition in nearly every vertical. The overarching trend, though, is consolidation around these major platform providers. That dynamic inherently favors Schneider's scale, integrated strategy, and ability to offer comprehensive solutions.
Okay, we've built a great picture of who Schneider Electric is and the massive evolving markets they operate in. But what genuinely protects them? What gives them a durable edge, those economic moats, against those formidable global titans we just discussed?
You've highlighted a critical concept. These economic moats are the traditional, durable advantages that create significant barriers to entry for competitors and protect long-term profitability. Schneider's competitive strength is deeply rooted in three interconnected moats. First, their sheer scale advantage. As a company with nearly $36 billion in annual revenue, they benefit from enormous economies of scale in manufacturing, global procurement, R&D. This allows them to be incredibly cost competitive and invest heavily in future tech. Smaller players just can't match that.
Makes sense. Hard to compete on price or innovation without that scale.
Impossible.
Yeah.
Really. Second, they possess a truly massive installed base in brand loyalty. Over their long, storied history, they built an unparalleled global installed base of electrical equipment. Think of iconic brands like Square D in North America. They've become industry standards.
Right, electricians and engineers grow up using that gear.
Exactly. Thousands of facilities managers, electricians, engineers worldwide were trained on and have relied on Schneider's gear for decades. This isn't just preference. It's deep-seated professional habit and expertise. Switching to a new vendor is a massive undertaking. Retraining, new certifications, potentially disrupting critical operations, that creates incredible inertia and really high switching costs.
Very sticky.
Extremely sticky. And third, they have an unparalleled distribution network. We're talking more than 15,000 distributor sales outlets globally. This extensive channel provides broad, immediate market access and forms a formidable barrier to entry for any aspiring competitor trying to reach such diverse and global customer base.
That's a powerful combination of traditional advantages. But here's where it gets really interesting, because our sources say they're not just relying on these. They're actively reinforcing these traditional moats with a sophisticated digital layer. And the centerpiece of that is the EcoStruxure platform. What exactly is that, and how does it create an even deeper level of stickiness for customers?
EcoStruxure is truly the technological centerpiece of Schneider's entire digital strategy. It's not just a product or a software package. It's an entire, vast ecosystem. Think of it as an open, interoperable, IoT-enabled system architecture designed to seamlessly connect and manage a customer's entire energy and automation landscape.
Okay, so it brings everything together.
It does, and it's structured in three distinct, interconnected layers. At the foundation, you have connected products, all their hardware, from advanced circuit breakers to intelligent sensors and industrial drives, embedded with connectivity and computing intelligence. The middle layer is edge control. This is on-premise software and hardware that aggregates data from these connected products and enables real-time control, monitoring, and automation directly at the local level in a factory, a building, a data center.
Processing closer to the action.
Exactly. And at the top are apps, analytics, and services. These are sophisticated cloud-based applications, often built on Microsoft Azure IoT. They provide advanced insights, predictive maintenance capabilities, enterprise-level management tools, basically transforming raw data into actionable intelligence.
And the open nature of EcoStruxure sounds really important for its widespread adoption and for building that ecosystem you mentioned. Why is that specific design choice so crucial?
Absolutely, that's a crucial strategic decision. The open nature, meaning it uses standard protocols and allows for third-party integration, is vital. It makes it far more broadly appealing and avoids the limitations of a closed proprietary system. Nobody wants to be locked into just one vendor's world if they can help it.
Right, more flexibility.
Way more. And this transforms the customer relationship. It moves from a transactional one-time product sale to a long-term, deep partnership focused on delivering measurable outcomes like significant energy savings, optimized operational efficiency, enhanced sustainability performance. That's where the real stickiness comes in. Once you're integrated into an EcoStruxure system, your switching costs become substantial because it's so deeply embedded in your operations. Pulling data, controlling processes, providing critical insights, becomes an indispensable part of your business.
And the strategic shift to software and services, which we touched on earlier, seems to be a huge part of reinforcing this digital moat. Why is it so strategic beyond just, adding to the revenue pie?
This is truly where the magic happens for both profitability and long-term value creation. This segment, which accounted for 19% of revenue in 2023, is not only the company's highest margin area, but also its fastest growing. The strategy is ingeniously twofold. First, leverage their massive installed hardware base to sell high-value, recurring field service contracts, ensuring their equipment is maintained and optimized over its lifespan.
Okay, the maintenance contracts.
Right. Second, and perhaps even more powerful, leverage the EcoStruxure platform to sell high-value software subscriptions and analytic services. The strong double-digit growth in field services in recent quarters clearly demonstrates the success of the first part. The second is exemplified by AV-EV's ongoing business model transition from perpetual licenses to a subscription model, with strong annualized recurring revenue,
Yeah.
AR growth being the key performance indicator.
That ARR growth again.
It's critical. This pivot takes their already robust hardware business and elevates it with predictable, high-margin revenue streams. It makes their physical products smarter, more valuable, and more indispensable with integrated digital offerings. It's a powerful multiplier effect.
Our sources also highlight M&A as a critical accelerant for Schneider's strategy, a systematic way they've built their capabilities. How has that played out, particularly with the very significant recent software acquisitions like AV-EV?
M&A has been a core pillar of Schneider's strategy for over a century. It's a tool they've used systematically to build out their portfolio and rapidly enter new, high-growth markets. They have a long and generally very successful track record with, I think, 47 acquisitions noted in our sources, including foundational deals like Square D and APC.
Right.
The recent technology-focused purchases of AVEVA, Ribe Software, and ETAP represent a clear, decisive, and multi-billion-dollar push to establish leadership in industrial and building software. The full takeover of AV-EV in January 2023 is truly a landmark move.
Why was it so significant?
Well, initially, you could argue it was somewhat defensive, a necessity to counter competitors like Siemens, who also have very strong software portfolios. Now, fully integrated, AV-EV is being used as an offensive weapon to create a unified ecosystem. Schneider is actively building a unified data platform, branded Connect, that integrates the distinct but complementary capabilities of AV-EVA for industrial processes, ETAP for electrical systems, and Rive for construction project lifecycle management. The goal: to offer customers a complete, holistic digital twin of their assets across the entire lifecycle, from design to operations and maintenance.
That sounds incredibly ambitious, connecting such disparate software platforms. But if successful, it could be truly transformative. What exactly does offering a digital twin mean in a practical sense for a customer?
That's a fantastic question, and it's where the vision really comes alive. Imagine a perfect virtual replica of a factory, a building, or even an entire energy grid. This digital twin, constantly updated with real-time data from the physical assets through EcoStruxure, allows engineers and operators to simulate changes, predict failures, optimize performance, without ever touching the physical asset itself.
Like a virtual test lab for the real thing.
Exactly. It's like having a crystal ball for your operations. If they successfully integrate these distinct software platforms into the Connect initiative to offer this comprehensive digital twin, it could create an unparalleled competitive advantage. It would drive significant pull-through demand for their connected hardware and make them an indispensable partner throughout the entire asset lifecycle. It's about creating a holistic, predictive solution rather than just selling disparate pieces of equipment or software.
And to maintain that technological leadership in these evolving moats, they must be investing heavily in research and development, right? What's their commitment here?
Absolutely. Schneider Electric maintains a very strong and strategic commitment to innovation through R&D. In 2023, the company invested 5.6% of its revenue in research and development, with a clear target to increase this to approximately 6% for fiscal year 2024.
How does that stack up against competitors?
It's competitive within its peer group. It's notably higher than a pure-play electrical peer like Eaton, for example, though perhaps slightly lower than a broader technology conglomerate like Siemens, which has defense and healthcare segments pulling R&D in different directions.
Got it.
But this R&D spend is strategically focused. It's not just about incremental improvements. It's about continuously reinforcing the EcoStruxure ecosystem and deepening their capabilities in those high-growth, cutting-edge areas. Think AI-enabled analytics, advanced software-defined automation, specialized solutions for high-density data centers, modernizing energy grids. This is how they ensure their moats remain strong, relevant, and at the forefront of technological advancement for the future. They're constantly innovating at the very edge of what's possible.
All right, let's talk numbers. Our sources provide a comprehensive 5-year financial summary that paints a detailed picture. What does that tell us about Schneider's growth trajectory? Has it been smooth sailing, or have there been significant shifts and strategic accelerations?
This is a crucial takeaway for you, the listener, because the numbers reveal a remarkably robust growth profile, but with an interesting and very strategic inflection point. Overall, revenue grew at a healthy 7.3% compound annual growth rate there from 2019 to 2023.
Okay, solid growth.
Solid overall. But after a very modest -4.7% organic decline during the 2020 pandemic, which in itself speaks to the essential nature of their products and services.
Right, even in a pandemic, people needed this stuff.
Exactly. After that dip, the company posted 3 consecutive years of truly impressive double-digit organic growth, averaging well over 12.5% per year from 2021 to 2023.
Wow, 12.5% average for 3 years straight. That's acceleration.
Significant acceleration. And this post-pandemic acceleration isn't just a bounce back. It clearly demonstrates a decoupling from traditional, more cyclical industrial trends. This resilience isn't accidental. It's a direct consequence of their strategic shift towards those non-discretionary, secularly growing end markets like data centers, grid infrastructure, sustainability solutions, areas that continue to demand their offerings regardless of broader economic jitters. Their performance significantly outpaces global GDP and industrial production growth, truly validating the foresight and execution of their strategic direction.
That's a strong growth story, especially in such a volatile period. But what about profitability? Are they getting more efficient as they grow, or are margins coming under pressure given global inflation and supply chain issues?
This is where their execution really shines. Alongside strong revenue growth, Schneider has delivered consistent and significant margin expansion. That's incredibly difficult in today's environment. Their adjusted EBITDA margin, which is their key measure of operating profitability, expanded by an impressive 230 basis points.
2.3% increase.
Right, climbing from 15.6% in 2019 to a record 17.9% in 2023. This achievement is particularly noteworthy because it occurred during a period of intense global inflation and widespread supply chain disruption. It speaks volumes about their significant pricing power and operational efficiency.
So they could pass on cost increases and then some.
And then some. The key drivers behind this robust performance include their ability to effectively pass through and even exceed input cost inflation, favorable operational leverage from higher sales volumes, and that beneficial mix shift towards the growing higher margin software and services business that we discussed earlier.
So those different business segments, we talked about energy management and industrial automation. How do their individual profitability metrics stack up? Is that two-speed nature reflected in their margins too?
Absolutely. The two-speed nature is very much reflected in their margins. There's a notable divergence here. In 2023, the energy management segment, which is riding those powerful secular trends, achieved a stellar 21.1% adjusted EBITDA margin.
21%, that's very healthy.
Very strong performance for industrial business. In contrast, the industrial automation segment posted a 17.0% margin. That figure for industrial automation was actually slightly down from the prior year, specifically due to the impact of weaker volumes in certain discrete automation markets.
Right, the cyclicality biting a bit there.
Exactly. This again reminds us that while industrial automation has strong long-term potential, energy management is clearly the margin leader right now, fueled by those robust and less cyclical demand drivers.
A truly strong business doesn't just make profits on paper. It effectively turns those profits into real, usable cash. How does Schneider Electric perform on cash flow? That's often seen as the ultimate measure of financial health and operational quality.
What's truly fascinating here, and a hallmark of a high-quality business, is their consistent and high free cash flow, or FCF, conversion rate. Net operating cash flow has been consistently strong, reflecting the quality of their operations. Free cash flow itself reached a record 4.6 billion in 2023.
4.6 billion euros.
Yeah, marking a significant 38% increase over the prior year. Their FCF conversion rate, that's FCF, as a percentage of net income, has been remarkably robust, averaging well over 100% across the 5-year period.
So they convert more than every euro of net income into free cash?
On average, yes. Which tells us that their earnings are not just reported profits, they are high quality, translating directly into cold, hard cash. This provides immense financial flexibility. They can self-fund crucial growth initiatives like R&D and capital expenditures while simultaneously pursuing value-accretive M&A like AV/EVA and consistently returning capital to shareholders through dividends and buybacks. It's a classic characteristic of a high-quality compounder-type equity. It reduces reliance on external capital markets and creates a virtuous cycle of investment and strong returns.
And finally, a quick check on their balance sheet. Is it healthy enough to comfortably support their ambitious growth plans, including those significant software acquisitions, or are they stretching themselves?
The company maintains a strong and healthy balance sheet, which is critical given their growth ambitions. As of mid-2025, its debt-to-equity ratio stood at a manageable 57.6%.
Okay. How did that change with the big acquisitions?
Well, this might seem like an increase compared to historical levels, but it's important to understand the context. This rise wasn't a sign of financial distress. Rather, it was a calculated, strategic use of debt to finance those major software acquisitions, particularly AV-EVIA.
Using debt smartly, then.
Exactly. A proactive use of the balance sheet to acquire higher growth, higher margin assets is a hallmark of value-creating capital allocation. Crucially, their debt load is extremely well supported by their powerful earnings stream, as evidenced by a very strong interest coverage ratio of 19.9x.
Almost 20 times coverage. Very safe.
Very comfortable. This financial strength and disciplined approach are recognized by leading credit rating agencies, which have assigned Schneider a strong investment-grade rating of AA3. While working capital management can sometimes be a use of cash during periods of rapid growth and supply chain constraints, as seen in 2021, overall their balance sheet provides a solid foundation.
Looking ahead, our sources paint a picture of truly significant, multifaceted growth opportunities for Schneider Electric. What are the key organic growth levers they're actively pulling across their different end markets to capitalize on these megatrends?
Schneider Electric's organic growth is robustly driven by strong demand across 4 key end markets, with data centers and networks being their premier, most explosive growth engine. It accounted for a substantial 21% of 2023 orders.
Okay, data centers leading the charge. No surprise there, really.
Yeah. Not at all. The phenomenal, unprecedented growth of AI, cloud computing, and overall digitalization is creating what many are calling a once-in-a-generation demand cycle for data center infrastructure. What's crucial here is that AI workloads aren't just more power-intensive. They demand a fundamental re-architecture of power and cooling systems that traditional data centers never needed.
How so? What's different about AI power needs?
Well, AI chips run incredibly hot and consume vast amounts of power, so you often need ultra-efficient, highly resilient power distribution and increasingly advanced liquid-cooled solutions, not just air conditioning. This is precisely Schneider's core expertise. They provide the full suite: specialized switchgear, transformers, UPS systems, advanced cooling. They project sustained double-digit annual growth in this segment through 2027.
Double digits for years to come.
That's the projection. And their strategic partnership with NVIDIA to co-develop reference designs specifically for AI data centers that places them right at the heart of this revolution. They're designing the very blueprint for the next generation of AI infrastructure.
So for the listener, this isn't just about supplying components to a hot industry. It's about being an absolutely essential enabler of the future of AI itself. That's a powerful position.
Indeed, it's a transformative role. Beyond data centers, infrastructure, accounting for 13% of orders, is driven by the urgent need to modernize aging electrical grids, integrate a rapidly growing share of renewable energy sources, and build out vast EV charging infrastructure.
Grid upgrades and EVs, yeah.
Huge drivers, often fueled by significant government stimulus, like the Inflation Reduction Act, IRA, in the U.S. Schneider offers advanced grid automation software, their EcoStruxure DERMS, smart grid solutions, medium voltage equipment to manage these complex energy flows. Then you have industry, 34% of orders. This is benefiting from the long-term secular push for Industry 4.0 adoption, greater automation, improved efficiency, sustainability initiatives. While this segment can be more cyclical, it offers strong long-term opportunities for their software and automation solutions.
And finally, buildings.
And finally, buildings, 32% of orders. Sees growth from the imperative for smarter, more energy-efficient commercial buildings and the accelerating electrification of residential homes. This includes integrated building management systems, energy-efficient HVAC controls, EV chargers, smart home solutions. They're even strategically targeting high-growth emerging markets like India for residential electrification, tailoring solutions to local needs.
And beyond organic growth, M&A is clearly still a very active part of the playbook for Schneider, right? It seems to be key to their transformation.
M&A absolutely remains a key component of their strategy. Used strategically to acquire new technologies, expand into new markets, and consolidate market share. They have that long and generally successful history of integrating companies. However, the ongoing integration of their major software acquisitions, specifically AV-EVIA, ETAP, and RIP software, is a critical ongoing test of their capabilities.
Making sure all those expensive pieces actually work together.
Exactly. Successfully weaving these distinct, complex software platforms into a cohesive end-to-end digital offering is paramount to realizing the full strategic and financial value of these multi-billion-dollar investments. This highlights that it's not just about buying companies, it's about making them work together seamlessly, creating a unified customer experience, generating that promised digital twin capability.
Right.
The execution of this integration will be a key determinant of their future success.
What about geographic expansion? Where are they looking for future growth, especially given their multi-hub strategy that you mentioned earlier?
Emerging markets represent a truly significant long-term growth opportunity for Schneider, driven by rapid urbanization, accelerating industrialization, massive infrastructure development. Regions like India, the Middle East, Southeast Asia are key targets where demand for electrification and automation solutions is surging.
Like the Indian residential market you mentioned?
Exactly. Their focused strategy there, with targeted product launches and local manufacturing, is a clear example of their granular approach to capturing this growth. Crucially, their multi-hub supply chain strategy isn't just about operational efficiency. It's a powerful strategic enabler for this geographic expansion. By producing approximately 80% of their sales within the same region as the customer, they effectively mitigate geopolitical risks, enhance agility by being closer to diverse local markets, and strengthen their position by localizing their value chain. This local-for-local approach provides both resilience and a responsiveness in an increasingly fractured global economy. One of the most interesting parts of our sources is how Schneider has so masterfully turned sustainability into a truly powerful commercial driver rather than just, a buzzword or a compliance checkbox. How does that work in practice? How do they monetize something that so many companies see as a cost? This is a truly masterful strategic move. A genuine aha moment in their business model, I think. Schneider Electric has positioned sustainability not merely as a corporate social responsibility initiative, but as a core pillar of its commercial strategy. Their mission to be their customers' digital partner for sustainability and efficiency directly addresses a pressing, universal need for corporations worldwide, the urgent imperative to decarbonize their operations.
Everyone's got carbon targets now?
Pretty much everyone. As companies face increasing pressure from regulators, investors, employees, customers to dramatically reduce their energy consumption and carbon footprint, they desperately need tangible tools and solutions. They need to measure, manage, report on, and ultimately reduce their environmental impact. This creates a powerful, durable, and ever-growing revenue stream for Schneider.
Okay, so how do they capture that stream?
Their sustainability consulting services act as the tip of the spear. They engage directly with C-suite executives on their high-level decarbonization strategies, helping them set ambitious targets and identify pathways. This strategic consultative relationship then creates a natural, logical pathway to specify and sell Schneider's own comprehensive portfolio of solutions.
Ah, the upsell.
Oh, it's more of a solution sell. From EcoStruxure software for tracking emissions and optimizing energy usage to energy-efficient hardware for reducing consumption, they provide the tools to actually execute the strategy they helped define. It brilliantly reframes a global regulatory and social pressure into a direct commercial opportunity, driving demand across their entire business and making them an indispensable partner in the global energy transition.
That's incredibly insightful, turning a global challenge into a massive business opportunity. Finally, what are the most recent developments and challenges from 2023-2024 that highlight their agility and ongoing strategy in real time?
What's truly fascinating here is how they've navigated an incredibly complex global environment with remarkable agility and continued strong execution, despite significant macro headwinds. They adeptly utilized their pricing power to offset rising inflation, which was a major driver of their margin expansion in 2023.
You saw that in the numbers.
Exactly. Their multi-hub strategy provided crucial resilience against the lingering supply chain disruptions that plagued many industries. Geopolitically, strong North America growth, driven by that insatiable demand for data centers and infrastructure investments, proved powerful enough to help offset weaknesses in other regions, like China's construction sector and a slowdown in discrete manufacturing in Western Europe. Financially, FY23 was a record year. 13% organic growth, that impressive 180 basis points increase in adjusted EBITDA margin, and this solid organic growth continued into 2024. Q1 at 5.3%, Q2 at 7.1%, Q3 at 8.0%.
Still strong, but moderating slightly from those huge post-pandemic numbers.
Moderating, but still very solid. And the two-speed nature of the business persists. Energy management consistently delivering strong performance, while industrial automation faced some cyclical headwinds. That offers a potential future tailwind once industrial cycles recover globally.
And what about their key strategic initiatives during this busy, dynamic period? Have they been active on that front?
Incredibly active and focused, they finalized the full AVEV acquisition in January 2023, integrating it completely into their portfolio. They acquired EcoAct, a leading climate consulting firm, further strengthening their sustainability consulting, offering that tip of the spear.
Doubling down on sustainability services.
Exactly. They formed that crucial strategic partnership with NVIDIA, specifically to co-develop solutions for AI data centers, a powerful signal of their commitment to the AI revolution. They also announced over $700 million in U.S. manufacturing and R&D expansion, directly responding to the AI boom and the incentives provided by the IRA. And looking forward, there was a planned leadership transition with Olivier Blum appointed CEO in late 2024. This demonstrates their decisive responsiveness to market demand and their long-term commitment to these transformative growth areas, continuously investing and evolving.
No company, not even a titan like Schneider Electric, is entirely without risks or headwinds. What are some of the key challenges they face as it navigates the road ahead, beyond just the usual business cycles?
That brings to mind another crucial aspect. What's the most significant long-term risk? The one that could genuinely challenge their strategic trajectory? For me, it's the digital and software arena. The bull case for Schneider is heavily predicated on the success of EcoStruxure and its integrated software strategy, particularly with AVEVA.
Right, that digital moat we talked about.
Exactly. If a competitor were to create a more compelling, more widely adopted, or even more open software platform, it could indeed risk commoditizing Schneider's hardware. It could reduce them to a mere component supplier within a rival's ecosystem.
That would fundamentally undermine their strategy.
It would be a profound strategic threat. And we can't ignore the black swan risk in data centers. While AI demand seems absolutely insatiable now, technology can evolve at breakneck speed. A disruptive breakthrough in AI chip architecture or software optimization that dramatically reduces power consumption could temper that explosive growth in demand for power and cooling infrastructure.
Okay, so the biggest long-term risk isn't just economic, but technological disruption in their core growth areas. What about more traditional, tangible risks that they still have to manage day to day?
Yes, certainly. There are still significant cyclical macroeconomic exposures. The industrial automation segment remains inherently sensitive to manufacturing capital expenditure cycles, as we've seen with the weakness in Europe and China in 2023-2024. A severe global recession would likely impact demand across all segments, even the resilient energy management business. Then there are operational and supply chain vulnerabilities, risks of raw material or component shortages, unreliable global transportation. While their multi-hub strategy significantly mitigates this, they are not entirely immune to major geopolitical events or widespread natural disasters.
Always a factor for a global manufacturer.
Always. Finally, regulatory, geopolitical, and currency risks are ever present. Operating in over 100 countries means navigating diverse energy efficiency standards, complex environmental regulations, export controls, international sanctions. Escalating U.S.-China tensions or significant currency fluctuations can also materially impact their reported results and operational costs.
Let's pivot to valuation. Our sources indicate Schneider Electric is currently trading at a premium compared to its historical averages. What does that mean for you as the listener and potential investor, and is that premium justified given everything we've discussed?
This is precisely where critical thinking is essential for anyone looking at the company. The market isn't valuing Schneider as a traditional industrial company anymore. It clearly perceives it as a secular growth technology leader, deeply embedded in essential megatrends.
The market sees the transformation.
It seems to. A review of its historical price-to-earnings, or PE ratio, shows a clear trend of multiple expansion. Over the last 10 years, it averaged around 23.5x. But that multiple has risen significantly from about 21x in 2022 to over 31x in 2024. Quite a jump. A significant re-rating by the market. It directly reflects its accelerating growth in energy management, the increasing and measurable contribution of the digital flywheel, and a growing appreciation of its indispensable role in the data center and electrification megatrends. When we benchmark against peers, Schneider trades at a significant premium to Siemens, a slight discount to Eaton, and broadly in line with ABB and Emerson Electric.
So why that specific valuation profile? A premium over some peers and a discount to others. What's driving those nuanced differences in market perception?
Well, the premium relative to Siemens appears justified by Schneider's more focused portfolio and its superior organic growth profile, driven directly by its greater exposure to those high-growth data center and electrification markets. Siemens is a broader conglomerate, maybe slower growing in parts.
Okay.
The slight discount relative to Eaton, on the other hand, likely reflects Eaton's slightly higher operating margins and its more concentrated exposure to the robust North American market, which has historically commanded a valuation premium in the electrical sector.
Interesting nuances.
Definitely. The key, however, is understanding that the current valuation implies that a lot of good news is already priced in. It reflects high market expectations. The current share price essentially prices in management's medium-term targets of 7–10% organic revenue growth and about 50 basis points of organic margin expansion per year through 2027.
That puts a lot of pressure on execution. So in simpler terms, if they consistently hit or exceed those targets, the valuation might be maintained, but if they falter, we could see a downturn. What would a bull case for further multiple expansion look like? And conversely, what are the key triggers for a bear case of multiple contraction?
In a bull case for multiple expansion, you'd likely need to see the cyclical industrial automation segment recover strongly, adding another tailwind, while the unabated data center growth continues to surprise to the upside, leading them to consistently exceed targets. Continued successful execution of their software transition, resulting in an even greater share of high-margin recurring revenue, could also lead the market to assign an even higher, more software-like multiple, reflecting that shift in business quality.
Okay, exceeding expectations, basically.
Pretty much. However, the bear case for multiple contraction would be triggered by any failure to meet those ambitious targets, a significant moderation in data center demand from its exceptionally high levels, or a deeper-than-expected industrial slowdown that drags down both segments. Such scenarios could lead to a derating, with the PE multiple contracting back towards its long-term historical average in the low 20s. The market is currently rewarding them for transformation and growth, and any perceived stumble in that narrative could be punished.
So for anyone tracking Schneider Electric or considering them, what are the most important actionable metrics to keep an eye on? The things that really assess their performance and the validity of this whole investment thesis.
These metrics truly tell the story of their strategic execution and financial health. For the group, focus keenly on organic revenue growth. Their stated target of 7–10% is the ultimate measure of top-line momentum.
Gotta hit that growth.
Absolutely. Also, watch adjusted EBITDA margin, organic improvement. This is the indicator of profitability and efficiency, targeting around 50 basis points of organic expansion per year. Free cash flow, FCF and FCF conversion are critical for financial health. Look for consistently over $4 billion annually and high conversion rates. And for the quality of their software business, annualized recurring revenue, ARR growth, is the most critical leading indicator, especially that strong double-digit growth at AV/EVA.
And beyond those core KPIs, what about some more forward-looking or segment-specific indicators that give us an early read on their performance?
Good question. The digital flywheel as a percentage of revenue is crucial for tracking their digital transformation progress towards that 60–65% target by 2027. It shows how successfully they're embedding digital into their core. Orders in the book-to-bill ratio provide a vital forward-looking view of their revenue pipeline. A ratio consistently above 1.0 indicates that demand is outpacing revenue recognition, which is usually a good sign.
Just the pipeline is full.
Exactly. We must closely monitor energy management segment growth, as it remains the primary secular growth engine, driven heavily by data center and infrastructure demand. Conversely, industrial automation segment growth is a key indicator of the global industrial cycle. Watching that shows potential for future tailwinds once manufacturing capital expenditure recovers. Finally, the Schneider Sustainability Impact, SSI score. While it's an ESG metric, it's increasingly tied to their commercial strategy and leadership in sustainability, so tracking its progress can reflect commercial success, tying back to that sustainability as a driver theme. #OutTrackOutro.
Wow, that was a truly comprehensive deep dive into Schneider Electric. We've seen a company with an incredible 190-year history that has successfully and deliberately transformed itself into a digital powerhouse, riding some of the biggest global megatrends like electrification, digitalization, and the urgent push for decarbonization.
Indeed. We've uncovered how their two-speed business model, fortified by strong traditional economic moats and that robust open ecostructure platform, positions them uniquely in these transformative markets. Their financial performance has been remarkably strong, driven by explosive growth in crucial markets like data centers and those strategic acquisitions in software, all contributing to impressive cash flow generation.
And they're clearly not resting on their laurels. Constantly innovating and strategically expanding into new geographies and market opportunities, even navigating complex macro headwinds with agility and pricing power.
Yep.
But of course, as we discussed, like any global leader, they face intense competitive threats and the critical need to continually execute on their ambitious software integration strategy to maintain and deepen that digital moat.
Absolutely. The shift to a digital-first, solutions-oriented company is undeniable and profoundly impactful. What truly stands out to me is their masterful ability to transform global pressures, particularly the universal mandate for sustainability and decarbonization, into powerful commercial opportunities. They leverage their extensive consulting services as a strategic entry point, driving sales across their entire portfolio. This isn't just a company selling products, it's a critical enabler for a more electrified, digital, and sustainable world.
So what does this all mean for you? Well, I hope you now have a far deeper understanding of Schneider Electric's strategic importance and business dynamics, and how it truly underpins so much of our modern infrastructure. From the smart homes we live in to the AI data centers that power our digital lives.
And here's a final provocative thought for you to consider. If the next wave of technological innovation, particularly in artificial intelligence, demands a fundamental re-architecture of our physical infrastructure, from energy grids to data centers, what other foundational industrial companies, traditionally seen as old economy, might be undergoing a similar, quiet, digital transformation? And what does that mean for the future of investment and global progress? How might these infrastructure enablers be the hidden beneficiaries, the uncelebrated architects of the digital revolution's next chapter?
Fascinating. Something to definitely think about. That's all the time we have for this deep dive. Thank you for joining us, and we'll catch you next time on The Deep Dive.